Good morning, afternoon, evening, wherever you are in the world. Welcome to the Zoom room virtual culture shifting weekend pre-culture shifting weekend event. My name is Andrea Hoffman. I'm the founder and CEO of Culture Shift Labs and Culture Shifting Weekends. As everybody knows, I think most people on the line have been part of or know about Culture Shifting Weekend New York. We have to date over the 3 years that we've been doing this event for 11 years, but 3 of which, this is the 4th year, we were focused on the theme of closing the inequity gap in venture. And we've enabled 150 million to get invested into GPs that showed up and met new LPs. And so Denmark West, my partner, and I are committed to doubling that this year, getting to 300 million. And we can only do that together with you. We ask everybody who's part of Culture Shifting Weekend to adopt the abundance and generosity, abundance mindset and generosity behavior. I'll give you an example of that. There was one GP that met an LP. It wasn't right for their fund. He made another introduction, and within 60 days, that GP got $20 million. So we ask that you show up with the same abundance and generosity attitude. With that, I'd like to hand it over to my friend Indranil. He came to Culture Shifting Weekend 2 years ago and was absolutely in love with what we had created. And we have created a partnership to have this moment. He's an incredible leader. He's an incredible consultant. He's an incredible enabler of other people's success and a new author. And I'd like to hand it over to you, Indranil, to get us started.
Well, thank you so much, Andrea, and it's a real pleasure to be hosting this Sovereign Wealth Fund session. Today, we're going to discuss a topic which I think is of global paramount importance, and that is the economic inclusion of people of color through investment. And specifically, we're going to talk about the role the sovereign wealth funds can play to propel this critical investment imperative. Now, we're all very acutely aware that the racial income and wealth gap has been a long-standing issue, and the COVID pandemic has only served to highlight how big and deeply rooted it is. In the US, for example, Black and Hispanic communities have suffered for decades from a lack of investment in their social services, their infrastructure, their businesses, and this has rendered their communities much more vulnerable in many cases to economic shocks. And this is exactly what we've witnessed through this pandemic. But this isn't only a US phenomenon. The same story is playing out in Afro-Caribbean, South Asian, and Middle Eastern communities in the UK and Europe and other developed countries. And in emerging economies like Africa and Latin America, which already require trillions of dollars of development investment to reach the living standards of high-income countries, governments are now faced with the additional challenge of providing safety nets to their people in crisis while continuing the development journey. So on a global level, I think there's no doubt that economic inclusion of Black, Indigenous, people of color, BIPOC, is a critical imperative. And in this session, we're going to focus on the African and Hispanic diasporas in particular, and talk about how we can drive economic inclusion through the exchange of capital, commerce, and innovation across continents. Now, we have a very distinguished panel of experts lined up today, representing sovereign wealth funds, but also development finance institutions and on-the-ground business building organizations that work with entrepreneurs of color. So let me introduce them to you. First of all, we have Stella Ojekwe-Onyejeli, who's the Chief Operating Officer of the Nigerian Sovereign Investment Authority. You could just give a wave, Stella. We also have Abdiel Santiago, Chief Executive Officer of Fondo Ahorro in Panama. We have Ross Strike of the Venture Capital Group from CDC, which is the UK's development institution. We have Janae Queen Nazaire, Chief Strategy Officer of Living Cities. And we have Darren Reedus, who's the leader of the Cincinnati Minority Business Accelerator. So the format for this session will be about an hour of roundtable discussion, followed by 30 minutes of Q&A with the audience. So if you come up with questions during the discussion, please write them into the chat in the Zoom, and we'll get to those at the end of the session. And maybe if you have a particular panelist you want to address your question to, please make that known in the chat. So let's get started. And maybe Janae, we can start with you. At Living Cities, I think your goal is to harness the collective power of philanthropy, of financial institutions, and of local governments to close the racial economic gaps in American cities. So you really have a panoramic view of the problem in the US. To set the stage, can you tell us about some of the key drivers of the racial economic gap in the US and how the COVID pandemic has exacerbated those challenges?
Absolutely. Thank you for having me on this panel. I'm honored to be here and share in time with all of you who are attending. So a huge thanks to you all. So in the US context, one of the things that's important to understand, some of the things that I'll share, is this notion of anti-Blackness. There is a poet who says anti-Blackness is the fulcrum that makes racism work. And I'd argue that it's the fulcrum that makes isms work across the board. And so racism, sexism, and more. And so, but it's based on Black bodies and the history of how we have used Black bodies in America. It's also based on, you've got human bondage, you've got genocide, and sort of land grabs, and moving people out of their homes and forcing them in other places, and then snatching people and bringing them over. And so you build an economy off of that. And so like at the root of a lot of those problems is this sort of dehumanization of these bodies. And so what that looks like today for us is that there's a 228-year wealth gap between Black and white people, 84 years between Latinx and white folks. And again, I'm using those extremes not because it's either Black or white. There's a lot. This is a continuum, but those extremes are important to understand because the outcomes that we see across any system, education, health, economics, business, home ownership, and so forth, are driven largely by the root of dehumanizing humans and sort of in free labor. And so we're constantly coming back to this, like, here are all the problems and, how do we solve them? At the rate that we're going, if we do nothing different, the average net worth, for example, for Black people will be $0 in the next 30 years. When you look at all American households, only 40% of them have $400 saving. They don't even have $400 in savings in the bank. And again, this is rooted in 246 years where most Blacks were enslaved, worked for no compensation, and could not accumulate wealth. So if I can't start back in the day and it doesn't get passed down, what am I going to do about that? And then you've got, following that, for the next 98 years, you have legal and ultimately unconstitutional anti-Black discrimination by the government, where lots of people suffer, not just Black folks, but for white folks in our rural areas, Latinx and other people of color trying to get in. And this was in redlining, where the banks drew red lines around communities and said, the government actually did it, and told banks, you don't have to lend there. You don't have to lend to those places. You all, if you don't know, home ownership is a proxy for wealth in the United States. Then you also have unequal lending. So I can go on a bank, and someone who doesn't necessarily look like me can go on the bank, and if they have white skin, they're more likely to get the loan. The data exists. The receipts are all there. If you're watching the news at all, the most recent 57 years has seen systemic racial biases in policing, education, housing, criminal justice, healthcare, and other institutions that work against the economic of largely Black households, but when they suffer, lots of folks suffer. And unfortunately, Indranil, COVID has only, some folks say it's exacerbated the problem. I'd actually say that yes, it has, but it's also just revealed the problem. It's pulled back the curtains on how deep the disparities are in our communities, where you have Black and Latinx folks and folks of color on the front lines, which we call the front lines working. Well, they have to actually work to simply survive, and some folks aren't surviving. Homelessness is rampant across the board. Black businesses are failing. Latinx businesses are right behind them. Asian businesses are right behind them, and compared to white businesses, which are at 17%. They shouldn't fail either, but when you don't value humanity and all in Black folks, Latinx folks, people of color, indigenous folks, everybody suffers. And so we're in this constant cycle of suffering that's a 400-year-old problem, at least here in Americas, and COVID is just adding salt to those wounds. So That's what we're up against.
Yeah. Well, I think that's a really good summary of some of the barriers and the challenges that we face. But what I love about the work that you do at Living Cities is how data-driven and rigorous you are about your programs and your investments. So I was wondering if you could tell us, first of all, a little bit about what Living Cities does, and also what you've learned, over the years from the places where investors could put their capital to have the maximum impact in narrowing some of these racial economic gaps.
Yeah, absolutely. So the first thing we had to do was reckon. We had to reckon with our blind spots. We had to reckon with America's history. We had to reckon with our approach to solving economic, or our approach to building economic opportunity for people was largely race neutral. So when we were, I guess, permitted to talk about race and understand the impact of that like changed a ton for us. And so we reclaimed our power and have convened the foundations and the financial institutions and the folks in our network to really think about the power they have within their roles. What access do they have? What terms are you in control of? And in our investment work through builders and benefactors, we're looking at underwriting criteria. Well, so what are we doing that we don't actually have to do? What might we do differently? Understanding the history of Black fund managers' application, in front of us. And so we're actually just using our power and our role and the tools that we have available to us. And so investors should deepen their knowledge around the history of disparities. Don't just assume. I think the other thing is that we've started changing the narrative that it's not that Black and brown businesses or BIPOC businesses are struggling because they don't have the wherewithal to do good business. It's that they're constantly under attack. And so when you're constantly under attack, you don't start with a $250,000 investment that you need to get started and be in the race. You're not getting the loans that you need to get. How do you compete fairly? So what we at Living Cities do is we really work against those norms. We call it out, we name it, we look very closely at applications and deals that come to us, and we take into account the narrative and the history. And so it sounds like, okay, well, some people look at me like I'm crazy. I know. And we do have the opportunity to test out ideas and create proof points so that we can we can share them with the market so they can take up. It's working. We've supported some folks right now who are GPs and they don't have administrative resources to go raise their dollars. So they got to do GP commit, and they have to run their business to raise the money so they can be in the private equity game, or they can be in the. So why not? Why not consider a deal doing that as a normal thing for Black, Indigenous, and other people of color investors? So those are some of the things that we've learned that they're still quite successful. They need a good place to start.
Thanks, Janae. Are there particular areas where the investment dollars could go, whether it's healthcare or certain types of infrastructure, that solve for some of the issues we hear about, like the food deserts and the financial deserts and the energy poverty? What are your programs in investing show there in terms of, or maybe even this financial services industry as well? What are your programs showing, and where we can close the gap with the biggest impact and the biggest return?
Yeah, so historically, we have worked. Infrastructure has been really important. Real estate in our previous life was really important, but technology, and not just technology for technology's sake, but how do you use technology to apply that over opportunities that we in businesses, products and services that we use in each and every day. How are we taking technology to Main Street businesses so that they have broader audiences? That's one of the things that we often talk about. We also work with local municipalities. And so I don't know if folks are familiar with the Pay for Success programs, but it was if folks got out of jail and they were situated well where they can get a job or start a business and be on track, we would see better outcomes for returning citizens. If that was the case, the organizations who manage that could get a fee from local government. That's another way that we have done something. So a lot of what we target, our infrastructure, food, health, technology applied to sort of main street businesses, all come with a social impact outcome in mind. So we've been testing across the board.
One of the things I think you just touched on there, Janae, is that the importance of the partnership between civil organizations like yourself, nonprofits, the private sector, and also government. And maybe I can start bringing in Stella here. First, to sort of build a little bit of a picture of what's going on in Nigeria and the African continent, but also to sort of pick up on how these partnerships can work. But Stella, perhaps you can just start by telling us, what's the impact been of COVID on the Nigerian economy and its people?
Thanks, Andranil, and thank you for having me here. Yeah, COVID has been something else. 2020 is a year we all wish never happened. On the African continent, globally, I think we're all aware that level of infections is around 33.4 million cases, with about 1 million deaths. In Africa, we have 1.4 million confirmed cases and 35,000 deaths. Those numbers were contributed by mostly by 5 countries: South Africa, Morocco, Egypt, Nigeria, and Ethiopia. And just to bring context, even the numbers are quite disparate in that group. So the topmost is South Africa with 667 cases and 16,000 deaths. In Nigeria, in contrast, we have recorded only 58,000 infections and 1,000 deaths. So, I mean, and I think this is across the African continent. The numbers, relatively compared to other parts of the world, have been low. Infection rates have been low. And interestingly, the virulence of the virus itself has also been low. And yes, there are all kinds of theories about why that is, but I think it's not unconnected with the fact that we have on the continent experience dealing with viral infections. You know, we recently came through Ebola a couple of years ago, and other such issues. And so the structures and the protocols that were used to tackle those were there and ready to just be called back into action. So I think that generally helped. But also because African governments were aware of how massive the impact could be and overwhelming of healthcare systems, they interestingly, regardless of the fact that infection rates were low, they still, in most of the African countries, implemented the most severe of lockdowns that, you know, it was available anywhere in the world. And of course, this had kind of significant impact on, you know, fragile economies of some of the African countries. So, but if I focus down into Nigeria, I think the impact for Nigeria was not just the lockdown impact, which, you know, is on the one hand, but also on the revenues of Nigeria. So when global activity ceased, we saw a drop in the price of crude because, you know, the activity requiring Nigerian Brent crude just wasn't there. Prices dropped, and so did the revenue of the government, meaning that we were hit in the pocket as well at a time where governments required kind of, you know, a lot of funds to be able to provide palliatives and support businesses and individuals. So it's been a very, very tough period economically for Nigerians, businesses and people alike. If I just look through the economy, I mean, our second quarter GDP numbers came out, and we had grown, I think, 1.3% in the first, showing how severe that impact of COVID has been on Nigeria. Businesses, and I think this might be the same globally, businesses, I think we had a mixed bag. So some sectors benefited, so certain healthcare sector players, telecoms businesses, any business that was kind of digitally enabled, logistics, all these areas kind of seem to have benefited from, you know, the activities around lockdown. But the hospitality, airlines, you know, those saw near total loss of revenues. the economy, a critical part of the economy is micro, small, and medium businesses. Those suffered significantly, and I think we can't take that lightly. I mean, huge job losses in that sector, teachers who were not teaching and not getting paid, the impact of people not having jobs is quite significant in our economy, where I think the stats are that about 86 million, that's nearly half of the population of Nigeria, are living in extreme poverty. So we have a huge vulnerable community. And all these people survive by activity of people who are in jobs. So where there are job losses or people's economic activity is impacted, then whole families that depend on people that are working are also impacted. So it was the impact has been really severe. It just as Jenny said, it's just laid bare structural imbalances and deficiencies in our system, showing the gap really between the vulnerable, the extreme poor and people who have. That group of people could not even comply with the lockdown rules because they have nowhere to go, they can't self-isolate. They need to work to be able to get enough to buy their $1 a day food,
Yeah.
So we resorted to a private sector came in big time to support the government to actually try and take care of these people because we needed to do that. Otherwise, we were going to see riots and a lot of chaos because they just couldn't cope. So a lot of private sector philanthropists came in to kind of buy food, both raw and cooked food, that would be distributed to vulnerable people, palliatives as we call them, done by both government and private sector. So it's been significant. Healthcare sector, clearly, I mean, we have inadequacies in that sector, but clearly totally overwhelmed. We actually had to have makeshift isolation centers built, again, by private sector philanthropists coming in to support the government all across the country. And those centers filled up pretty quickly, I think luckily, and I say that in quotes, that the infection rate hasn't been too high. And, the critical cases have been such that even though the systems are inadequate, we've kind of been able to cope. So, it's been a tough ride. It's been a tough ride. I think the experiences are probably similar, but
I think there are a lot of parallels there, and particularly around, the fact that there are vulnerable communities in all societies, and the importance of being able to invest in key sectors and businesses to sort of keep people afloat through this crisis, but also going into the future. I think one of the important things to understand about sovereign wealth funds is they can have multiple functions. One of them is short-term stabilization in times of crisis and shocks like this. A second function is sort of medium term, which is developing the economy, its infrastructure and new industries and investing behind that. And the third one can be, investing for future generations, which usually involves a portfolio investment approach, usually in overseas assets. Now, I think it's very interesting that NSIA has all three functions, which is actually a little bit unusual for a single sovereign wealth fund. It's sometimes divided across different funds in a given country. But, as you look at that, very broad mandate, what can you tell us about, particularly those first two horizons, sort of the short term and, the medium term, which is the short term being addressing some of the challenges you talked about. Secondly, the medium term, which is developing the economy for the future. What are the kind of actions you're taking, the investments you're making? And very important for this panel is how would you see yourself sort of working with venture capital and private equity firms, perhaps from other countries who want to build a presence in Africa, be part of the solution, and also companies who want to come in and do the same thing and be part of the solution in Nigeria and Africa as well. Could you tell us a little bit about, what you're doing, how you would like to work with these other parties?
Yeah, we are one of the very few sovereign wealth funds with this triple mandate. The stabilization one is really short term. And I talked earlier on about the challenge to government revenues. So for the first time in nearly 8 years of our existence, the federal government actually called on us for some funds. They called for $150 million that would assist them in, running the budget until other arrangements that they were making, borrowing from multilaterals, came through. So, we saw for the first time that fund, and that's the purpose of the fund anyway, that fund being addressed. On the medium, so longer term, we have the Future Generations Fund. And because it's a longer term horizon, that's where we have a mix of asset classes. So we do private equity, long only equity, alternative asset classes, and like. That's the fund through which we might, we have done, and we might be able to support diaspora or other international folks that are interested in coming into Nigeria. We recently started doing so. At the onset, of course, we were quite conservative and didn't do venture capital. But of recent, we have opened up to venture capital, and would be interested in looking at opportunities. I mean, and even if we don't invest, we are very much open to being like a bridge, or a party that can introduce people who are interested to other parties in Nigeria that might be interested, that they could co-invest with, or even GPs that are looking for funding that they can invest in. So we can play that role. We have played that role in the past. We can play that role. At the time we started, PE in Nigeria was actually quite nascent, I would say. There were very few. In fact, there was only one PE firm that was pretty much well established. There were other African PE firms investing in Nigeria, but not in Nigeria. There was only one based in Nigeria investing in Nigeria. But since then, the space has actually opened up, and we've been quite instrumental in supporting that by being like a first mover in funding some of these GPs who are what we call emerging GPs. They don't have a long history, but you can see what they've done in the past, and we want to support them. We want to open up. We want to help to catalyze funds to come to them. And so we've supported a number of Nigerian GPs that way. The other fund we have is the Infrastructure Fund, and that's the one through which we impact, I think, more substantially in economic development. We have a broad focus area. This is mandated by our Act, all aspects of infrastructure, but we've narrowed down because it helps us to basically just be more focused and to identify areas that will have the most impact when we intervene. So we've narrowed down our focus to healthcare, to power, to agric, to roads, to motorways or toll roads, and more recently, gas infrastructure. We had real estate, but we switched that out for gas industrialization. So these are areas that we believe we would be most impactful. As I said earlier on, COVID has actually shown, or just made it clear to us, that in picking up on agric and on healthcare and industrialization, we actually picked the right sectors, because I think one thing nobody factored was any event that would mean that the whole world was all shut down at the same time. Shut down to traffic, shut down to movement, shut down to everything. So we suddenly found ourselves in a situation where if you didn't have it in your ecosystem, then you didn't have it. There were these crazy price wars over PPE, by the powers that be in the US and other parts of the world. And the likes of Nigeria, we couldn't even get airtime. So, it became clear to us that we have to become self-sufficient. On the healthcare space, the stats are that Nigerians spend like $1 billion annually on medical tourism. Mostly non-communicable diseases. They go for renal transplants. Cancer is a big one. Brain and heart surgery. But with COVID, people couldn't leave. everybody was here and had to deal with inadequate healthcare system. So it's become so clear to us that we need to, continue our focus. And we have actually done a few investments in that area. We last year, a cancer treatment center, which is the best equipped in Nigeria, most probably in West Africa. And that's doing really well. We get testimonies from there every day. We launched 2 diagnostic centers this year, and they've also been very well received in different parts of the country. On the road sector, we are very big in the road sector. We are working on 3 federal road projects, a combined cost of around 2 billion in the north, west, and southeast of Nigeria. And when those roads are ready, we're in construction phase. When those roads are ready, they'll be massively impactful on all the population along those corridors. They will engender better logistics movement, interstate movement. I mean, the impact will be quite significant. So these are some of the areas that we're working on, and some of the things.
I think the opportunity seems clear in a lot of those sectors with health and infrastructure and energy and industrials, where there's clearly a lot of room for growth, and there'll be opportunities, I'm sure, for partnership with yourselves and with other parties in Nigeria that you could help facilitate connections to for companies and funds, wanting to participate. Let me bring in Ross from the CDC at this point. Ross, maybe you can continue to paint the picture of what's going on globally in terms of the racial economic gap. Tell us a little bit about how things are poised there in the UK and in Europe, and also some of the other emerging markets that you're involved with. What are some of the parallels with what we've heard from the US and Nigeria, and what are some of the differences?
Yeah, sure. Thanks, Janelle, and thanks for having me on the call today. Like you mentioned, look forward to comparing notes and sharing different perspectives across markets. I guess starting with the UK, it's probably not shocking to anyone the shared history. There's obviously massive racial inequalities. I mean, even in our own institution, CDC, which is a bit unique, where probably more than half of the staff are people of color, we still face lots of issues of unconscious bias and inclusion issues, and as an organization trying to deal with those like any other organization. So it's not like having let's say an Africa focused mandate solves that problem either. I think it's always an ongoing thing, and that's definitely been something that I think some of the Black Lives Matter movement that started in the US has been equally top of mind for people of color in the UK, and definitely in our organization. But moving more to where we're investing, which is today mostly Africa and India. I think Africa is an interesting case because you really see the history and unconscious bias and how that affects investment decision very clearly. Where for the last 10-20 years of the African private equity market, very few of the decisions, at least in terms of capital coming from abroad, has been made by Africans. And only in the last few years, thanks to some of the GPs on the call and LPs like NSIA and some efforts from ourselves, are you starting to see, I think, more real local GP capacity develop. And I think especially in the venture capital space, that's really important, because obviously GPs are ultimately making a bet on the entrepreneur, and it's a very personal decision. And so having GPs that are really local insiders, understand local entrepreneurs, understand the customers in each market is very important. And I imagine a lot of that same kind of thinking applies to selecting GPs in a US context.
Ross, I think one of the things that you could maybe tell the audience about who may be unfamiliar with the CDC is how your investment model has changed over the years. Because at some point you were doing direct investments, but now, as I understand it, you invest solely through funds. So can you sort of chart that history a little bit and talk about now that you invest through funds, how you look at that investment model? What are you looking for in the type of funds that you invest in, and what are the goals and objectives you're trying to achieve?
Yeah, sure. And like any institution, I think these things are always a bit more complicated, but I'll give the simple version. I mean, CDC's been around for 70 years, originally the Colonial Development Corporation. So you can imagine, that's gone through a lot of different iterations over the years. Today we're just the CDC, so that's no longer has any real meaning to it. And today we actually do funds, direct investing, and debt investments. I sit on our venture capital team, which is primarily fund investing. We do some co-investments as well with our GPs. So again, it's a mix of everything. But when we think about venture capital, especially, I think the funds model, again, in terms of backing investors who really know the markets, are insiders, have a local presence on the ground, things that probably seem pretty obvious to a lot of people on the call. The funds model as an international investor really makes a lot of sense. And so a big part of our mandate is building, let's say, local GP capacity, investing alongside people like NSIA, trying to bring in GPs from the US and the UK to, again, really build local capital markets is a big part of it. As an institution, we want to achieve financial returns like any other private investor, but obviously top of mind is our impact mandate. And ultimately that is about supporting economic growth, driving inclusion. And that's where I think, echoing some of the earlier thoughts, the role of technology, whether it was mobile telecoms and towers over the last decade, and today a lot of the tech-enabled company, again, like Janae said, not technology for technology's sake, but tech-enabled solutions to really drive, lower costs and therefore access to, let's say, the average Nigerian is really exciting. What we're seeing, I think the last point I wanted to make, linking back to the topic today, is we're seeing a lot of great Black American entrepreneurs coming over, African diaspora. They're going to Wharton, or doing their school in the US and returning back and creating great businesses. So that exchange, and same with the UK, and that exchange of talent and capital, I think, is going to be a really important trend to watch over the coming decade. Because obviously, when you look at how the venture capital ecosystem in China or India evolved, that exchange of especially know-how and education from Silicon Valley was very central. So we're already seeing a lot of top GPs, including a few on this call today, Africans who spent a lot of time in the Valley, learned it there, and bringing their best practices to drive the Africa VC market development.
I think the example that you chose in China, for example, was interesting because it partly was diaspora driven, and the return of qualified people of Chinese descent to build up investment practices and businesses. But one of the key features was the ability to build these very large national, sometimes global champion type businesses that then employed vast numbers of people in the rest of the economy and supported that local development that you're talking about. From your perspective, what kind of things are you doing, or success models that you've seen that can not just bring that sort of talent and capital, to a place like Nigeria or an emerging economy, but also, or even a developed economy in some of these sort of more challenged communities, but also build that talent and that capacity locally?
Yeah, I wish I had a good answer for that. I think that's the $1 million question. I mean, obviously the China boom was catalyzed by low-cost manufacturing, selling to the US. And I guess there's a theory that you need kind of an external catalyst to drive economic growth. And maybe that's true over a short time horizon. But I think if you're patient capital, which is maybe the role for sovereign wealth funds and development finance institution, we think about a 10, 20-year horizon in a lot of our investments. On that horizon, I think just looking at the demand for essential goods in these markets, like Stella said, tech-enabled logistics, agriculture. There's so much opportunity for innovative companies and entrepreneurs to tackle problems that I actually don't think the demand side is really the problem. It is like entrepreneurs with the right mindset and ability to take risk. So of course there is a talent gap, and I think it's not so much an entrepreneurial talent gap so much as maybe there's not as many great UX designers or some of the really like software technical skills, and that applies to hard engineering areas as well. So that's where I think the exchange of talent is really critical. But for me, the biggest gap today is still the financial capital. Because as Stella said, I mean, for most Nigerians, even great entrepreneurs, you don't have the social safety net, you don't have the personal capital to take the big risks. And I think that's why, having venture funds to find those entrepreneurs and bet on them and give them the capital to get started, it can really drive change quickly. But of course, it has to evolve and with the macroeconomic reality as well. There's not going to be any, I think, an easy wins or magic that's going to happen either.
Yeah, it sounds like the catalyst to get talented entrepreneurs, off the ground, and also investments that increase the affordability and access to basic things is a part of the solution here. Let me bring in Abdiel now from Panama Sovereign Wealth Fund. And this is a sovereign wealth fund that is really more focused on external investments because the mandate is more about the future generations. And so a lot of the investment happens outside of Panama. Abdiel, can you tell us a little bit more about your fund's investment model and how you're sort of looking at some of these economic inclusion issues?
Thanks, Indranil. Thanks, everyone. So this is a sovereign wealth fund. I think is probably one of the only sovereign wealth funds in the south of the Rio Grande, I should say. You may have a fund like Chile, although I think over the years they have de-emphasized the whole sovereign wealth fund mantra. So this is modeled after an endowment type investment profile. So what we seek to do is invest capital over the long term for, or in the case that there is a national emergency, natural disasters and these type of things. Clearly 2020 brought us one. I can explain a little bit more about how we have provided funds in response to that. But the fund itself was created in 2012, and it basically was modeled after a normal, what we call a normal sovereign wealth fund definition, which essentially is you take capital that you are generating from a natural resource, and then you invest or you set aside a couple of some percentage of that and invest it. In other words, you don't spend everything that you have. We don't have any natural resources, at least we haven't found crude oil. I think we do produce Panama. Panama does produce copper, but our closest thing to a natural resource for us is the Panama Canal. And so the original idea of the fund, how the fund gets funded, was through excess income from the Panama Canal. And so that's sort of the model. We invested in the long term, and as you say, Andrea, we don't invest in the country, and the reason is pretty simple. I mean, we want to diversify the cash flows that the fund is generating from what's happening inside the country. So if you have a natural disaster and you're investing in companies, you want that capital, you want those funds to be available exactly during the crisis. And so if you have a crisis inside the country, you can't liquidate, you can't utilize it, then you have a little bit of a problem. The only, I would say the only problem with that is that, when the problems are happening everywhere, that's a very unlikely scenario, but it kind of happened this year where, access to the funds was a little bit affected, just giving, the way that the market responded, from the onset of the coronavirus. I'm speaking specifically around the end of April, where things basically came crashing down, and so that's just a scenario that we just did not count on. But overall, this is a fund that tries to invest globally, although predominantly is in the U.S. We have around 85% of our investments are are in the U.S. And actually yesterday we announced our first foray into private equity. We'll see if we are late to the party or not. I don't think so, but it's about 5% of our fund. Our fund is about $1.4 billion, and so 5% of our fund will be invested in the private equity space, more specifically the secondary space, because we think that as new private equity investors, we have to sort of look out for the cash flows and making sure there is income coming in. And if you look at if you sort of look at the secondary, the primary investments, the cash flow situation there's probably a little bit more delayed. Really talking about the J curve, or the so-called J curve. So we're entering into the secondary investment. So that's another sort of change in our strategy, our investment strategy. The situation with what's going on, not only with coronavirus, but obviously the George Floyd killing and all these other social things that have been going on, has really accelerated. And just for reference, I've lived in the U.S. for 25, 30 years, so I'm fully aware of the dynamics that we're seeing today. So, but it has really accelerated, sort of, or it's brought to the I would say the conscious the issues around racial inequality, especially for folks that are Afro descendants. And in Panama, as you probably know, we have a pretty strong and vibrant Afro a community, people of Afro descendants, and on top of that, we have indigenous people. One of the only places that in South America that still has indigenous people that have been largely untouched. And then obviously, we have a mix of people. I mean, Panama's a very mixed, racially mixed country. But if you take a step back and look at Latin America overall, the COVID crisis has not only amplified the issue of race, but also of income inequality. A lot of the folks are saying to politicians and others, I'm not sure if I'm more scared of the hunger virus than I am the coronavirus, because you have to make a living. And one of the issues and we don't know where this is going to end overall in Latin America. What's kind of concerning is that you have seen progress over the last 20, 30 years in terms of poverty. That rate has come down, and all of a sudden, we see this in 6 months spike up pretty significantly. Who's going to suffer there the most? Obviously, folks that don't make a lot of money, women, who a lot of times have to carry children and also work, and so that said, from an investment standpoint, and we focus now on the U.S. We see a situation where if there's a dispute between the U.S. and China, and the situation with trade, that is a perfect opportunity for Latin America to sort of engage in some of these onshoring opportunities. Bringing back some of that production that's out there in Asia, bring it here, and so just from an investment standpoint, and just basically looking at your opportunity set, this is something that is on the horizon, and it should be really on the short-term horizon. Let me just say one other thing, in terms of the U.S. perspective. I think I don't know when exactly it was, 20, 30 years ago, there was always this talk about emerging markets and investing in emerging markets and looking at the U.S. Or pockets of the U.S. as emerging markets, especially in the urban community. So, and people do invest in the traditional definition of emerging markets, which is, offshore. So why do you invest offshore? And, really just one reason, higher growth, higher returns. But then you have an issue of exchange rates. And so I guess, going back to the premise of your question, this is just an opportunity to sort of revisit that view of the U.S. having, pockets of emerging market opportunity all around the country. And the U.S. is a huge country, $17 trillion in economic growth. So this is, what's happening now, I think, is just creating the groundwork to revisit that concept of emerging market, and you don't have the exchange rate issues that you would in other emerging markets. So let me just stop there.
That's a really interesting perspective, Abdul, which is, as an investor like yourselves, investing a lot of your capital in the U.S., there's an opportunity, you're saying, to invest in, sort of venture funds and companies that would have potentially an interest and a role in building up sectors in places like Panama and elsewhere in Latin America as, trading partners and sort of providers for the U.S. as an alternative to China.
Right. And what that takes is, organizations such as the IFC, you have the U.S. Development Corporation to sort of fuel those opportunities with capital. But again, I think it's a huge the reality is that the region is going to need it. There's no shortage of need when it comes to these funds. I happen to think that Panama would be a great place to invest in those opportunities. But then if you look a little bit north and you look at Central America, you have the issue of immigration and a good way to sort of revitalizing these countries and creating opportunities for people so that they don't have to go out and out of their country and basically help their country grow is through investments. I mean, I think the U.S. These international organizations, they have to look at this particular region without put in a good look as to how they can invest heavily in these opportunities. So I agree.
Let me bring in Darren. Darren, you've been waiting patiently, but let me bring you in as the leader of the Cincinnati Minority Business Accelerator. I think we've heard lots of examples here of funds like Abdul's, like Stella, looking at opportunities to support funds and businesses in the U.S. or other developed countries that have a relevance to the economies, to their home economies. One of the questions might, be, is there enough, or where do you find minority-owned companies or such companies to invest in? And in some ways, Darren, you're a manufacturer of those companies through your accelerator. Can you tell us briefly about, what the mission of the Cincinnati Accelerator is, what your model is, and the kind of success that you've had in terms of impact?
Sure. Thank you, Janelle. Pleasure to be a part of such an esteemed panel. Yes, so the Cincinnati Minority Business Accelerator is actually housed in the Cincinnati Regional Chamber of Commerce, was actually birthed out of Cincinnati's own civil unrest back in 2001. and was actually created before there was a landscape of accelerators. This accelerator is a bit different, whereby today's accelerators, by and large, identify cohorts of businesses, run them through a series of trainings and such, and graduate them. We actually don't graduate businesses. We've been working with these entrepreneurs since inception. This work started, as I mentioned, in 2003 in response to our unrest here as a way to try to get to the economic roots of so much of the challenges that we're all talking about. It was then and now rooted in a supply chain strategy. So it was very much an intentional effort with our region's corporations and largest employers. We began with about 20 businesses that all had to be, our initial sort of landscape revealed about 20 businesses, African-American businesses that were at least $1 million in annual revenues. And so that became kind of the starting group. And so 1 million in annual revenue, a B2B or B2G business model, and the desire on the part of the entrepreneur to scale. We know that certain entrepreneurs get to a certain level that creates a decent lifestyle for themselves and their family, which is fine. We were looking for folks that really wanted to become much larger enterprises. And so today, that is a portfolio now that has impacted 67 such African-American and Latinx businesses. In the aggregate, it's over $1 billion in aggregate annual revenues, over 3,500 jobs created since the work began. I came on board in 2016 to look to try to take this work to the proverbial next level, which we defined as growing by an incremental billion and creating an incremental 3,500 jobs, which we are doing through 4 fundamental buckets of work, which we call kind of grow, build, attract, and create. The grow bucket is fundamentally, let's just grow the current businesses of size that we have to their next level. So if they're already at 10 million, how to get them from 10 million to 20 million. If they're already at 50, how to get them from 50 to 100. Bunch of tactics up under there, but fundamentally, grow is about growing what we have to their next level. The build pillar is about building a pipeline of emerging minority firms. This is businesses under $1 million that we believe have high growth potential. We've set an ambitious objective to identify 10 a year or 50 over 5 years. We're actually profiling 12 such companies in the community as we speak. The attract pillar is trying to attract larger, diverse firms to the region in gaps where we don't have them in our community. We're targeting businesses north of 20 million in that bucket that align with our regional strengths like manufacturing, chemicals, aerospace, about 200 minority businesses that are prospects that we're trying to do business in the region in hopes that that business leads to them putting an office in the region or expanding to the community. So it's not about uprooting them, but having them expand to the community. And then finally, our grow bucket, which is getting a lot of traction. Our create bucket is creating minority businesses through the acquisition of mainstream, or if you will, non-minority firms without succession plans, no kids in the company interested in taking it over. How can we identify credible minority buyers to acquire mainstream companies of size and create minority businesses already with scale and capacity day one, as opposed to trying to grow everything organically? We are also in the process of standing up a fund, a CDFI fund, to invest across those 4 pillars, which will also invest outside of our region as well. So to your point, Janelle, about manufacturing the entrepreneurs, it's a number of sources, if you will, that drive that. Many of our entrepreneurs are former employees of our corporate community. That Procter & Gamble is a great example of that. And so, as I mentioned as well, the buying commitment on the part of our institutions has certainly contributed greatly to that work. But it's also, in my opinion as well, this emphasis on scale which we don't see that often, in my opinion. And as important as supporting smaller micro enterprises are and neighborhood businesses, that has to be a key part of all of our work. But there also has to be a greater emphasis, in my opinion, on growing larger, diverse firms of size. You see, even now in the supplier diversity arena, which has been in many ways the lifeblood for growing the larger, diverse firms that we have across the country. But even in the supplier diversity space, as many corporations are consolidating their supply chains, which flies in the face of small business and disproportionately minority business, you have to have more vendors that have the capacity and wherewithal to take on greater projects and greater geography for their corporate customers, which is begging strategies like joint ventures and acquisitions and the like. And so we're excited in a difficult time to be a group that has been at this now for 17 years. Again, well before there was a landscape of accelerators, really born out of our own challenges and our own unrest, but we're making good progress.
Darren, thank you for that. And I think the launch of your fund is a very direct opportunity to invest in this wellspring of scalable and potentially national, global champions, if you like, coming out of Cincinnati. One thing I would also just like to mention to the audience before we go to Q&A is Darren, won a prestigious grant, his organization, to build a playbook to help recreate the model of the Cincinnati Accelerator in other cities across the US and perhaps internationally. So hopefully there's more of this type of organization and funds associated with them that will be investment opportunities in the future. But let me turn it over to questions now from the audience. And it would be great if you can unmute yourself and ask your questions briefly and succinctly. And if you would like to address it to a particular panel member, please do so. These sessions are very much about impact and outcomes. We're trying to make connections. We're trying to get things to happen here. So please be direct in your questions. So to the audience, anyone who has a question for any of the panelists.
Good afternoon. Good afternoon. My name is Mike Anderson, better known as Prez. I just sent you guys in the chat a link to a story we just dropped yesterday in Newark, New Jersey, where we're based, and we discussed creating a national paradigm for investing in Black communities alongside Mayor Baraka and Reverend Sharpton, and announced certain initial commitments, which will be investing in real estate developers as well as Black businesses, principally located in Newark, New Jersey. And I just heard the gentleman from Cincinnati mention creating a scalable economic model. And I would love to just see if there's any energy in terms of the formation of a fund of funds, potentially like a Blackstone model, so to speak, which is aggregating these individual and discrete investment vehicles with the collective intention of creating a sustainable diaspora framework in support of what we discussed yesterday in Newark, in which I'm sure many of you guys are doing in silos, but maybe not necessarily coordinated with the intent of having a deliberate vehicle doing this.
So I'm not sure, I guess, what the particular question that you have there.
When we announced what we're doing in Newark, the sentiment was, how do we go from one city announcing one investment initiative for Black businesses and developers, which is obviously going to be a fight in order to execute, to a global ecosystem and aggregate vehicle, sort of like a fund of funds operating in conjunction. So to give context, I know about a year ago, the Minority Business Development Administration was discussing that they wanted to create a digital ecosystem for the entire minority world, but they never followed through with that discrete funding in order to see this implementing. And as a result, we all kind of operate in silos where every city like Cincinnati and the gentleman in Cincinnati has an incubator, but they may not necessarily be communicating with what we're doing in Newark and what we're doing in Philly. So my question was, if there was energy or any type of commitment looking toward fulfilling a role that obviously the government, our federal government should be playing, which is aggregating the sum total of what we're doing as individuals and what we're doing as discrete individual communities.
Yeah, I can certainly address that, and there's a lot of answers to that. I will say that in our particular case, with the focus that we have with the fund that we're establishing, it is looking at a bit of a broader geography than, of course, just Cincinnati region. Janelle mentioned this playbook that we have been fortunate to have funded through a national foundation. And part of that playbook is designed to try to not just inform our work, but connect with other communities, much of which to the point you're talking about, so that we can look to, in certain cases, partner up entrepreneurs from could be a JV perspective. Again, I'm talking more at the deal level as opposed to perhaps the fund of funds level. I do know at the fund of funds level, there has been discussion with the Minority Business Development Agency on some of that work, which we can probably just talk more about offline, but that is certainly has been discussed. There's work that, so that is a particular fund of funds approach through the MBDA that has been discussed now for the past probably 12 to 18 months. And so there's some of that work happening, but I couldn't agree more that there's got to be and should be far more connectivity to leverage the collective resources of what we're doing, for sure.
Thank you for that.
So, go ahead, Janae.
No, I would just, go ahead, Denmark, you go, because you'll probably say the same thing I'm going to say. Go ahead.
I was actually just going to try to tee you up. So, you're already there. I've already done my job. Go ahead.
All right. No, great. This is one of the things. So I would love to be in touch with you, sir. I think this is one of the things that Living Cities is uniquely positioned to do, is to serve as a clearinghouse or a neutral space to collect the data, to aggregate it and see what's going on, identify gaps, and look across so that we can lift up what's working, what's not working, and why. And why we're uniquely positioned to do that, because we are in philanthropy. We said, foundations and financial institutions are my members. We're a nonprofit. Our skin in the game is so that people are well and economically secure and building wealth, which is a little different than what's happening on the ground. And so I think this is something that we would definitely be interested in considering and welcoming, just the data and the opportunities. Can I just add one more thing? The thing that I will encourage, even with what you just shared, Sarah, is that we have to stop operating by status quo standards, because
Amen.
The status quo standards were not created to include us, and by us I mean BIPOC communities and low income folks. What I am seeing across the nation from where I sit is that there are all of these are popping up everywhere, but we're using the same standards the market has, and it's actually not working for us. And so that's the other thing that why I started the way that I start, and why you will hear me beat this drum. But what does risk mean to you, right? What does it mean to you, and what are the standards that you're using, and who set them? And so the ways that we're going to see growth and economic inclusion, especially for BIPOC communities and those who've been marginalized, we have to set new standards. We have to set new practices and ways of being. We have to buy into this notion of collective shared faith. And so I want to offer that, because I'm not always going to talk about all the technical deals and things like that. I'm going to talk about your beliefs. I'm going to talk about your behaviors and how we show up in any space to just really move the needle and change our environment and the conditions so that we're all better off. That's what you're going to get from me and us at Living Cities. But we welcome being a part of pulling things together.
I want to add to something you said. A quick aside. Yesterday, when we had our event in Newark, we had a lot of great respected leaders that have been forcing this conversation from an institutional level, whether it be pension funds, philanthropic institutions, and even getting companies like Prudential to diversify how they spend. One of the discussion points was a story of a young Black woman that was renting out her Airbnb and had a white-facing woman's picture on the Airbnb. And she was saying she needed to do that in order to make, a couple $100s. And then if we scale what that looks like in terms of how we all feel like we need to comport ourselves in order to be respected as partners, how sustainable is that? So I really echo what you're saying in terms of reframing how we even can see risk, track record, all of this. And I welcome everybody to look at what's happening here in Newark, New Jersey as one instance and partner with us and partner what we're doing at Impact to help create that more sustainable model, which is helping develop our communities and allowing us to have more of a social impact, because we don't necessarily have to even pretend to be looking or analyzing returns in the same way that a traditional financial institution was. We'll never win like that. So thank you guys, and thank Denmark and Andrea for putting this together.
Yes, thank you for that. Well, there is a question from Karen Kerr of Exposition Ventures, and that is to Abdil. And Karen asks, is venture capital part of your mandate? And to what extent do you see technology helping to enable reshoring of manufacturing in Latin America? Abdil.
Hi, venture capital. You know, at our fund, we have to sort of crawl before we can, before we can walk. It's so the short answer is within our mandate. It is just not a focus for us right now, and just just to explain why, when we look at asset allocation, and I might get into the weeds a little bit, but when we look at asset allocation, we look at asset allocation from an asset standpoint. So you have bonds, and within bonds you have a whole bunch of other different type of fixed income investments, and then you have equities and you have cash. And so when we look at the private equity focus and we include a private equity into a portfolio, again, forward looking 5 years out, then what we were looking for was for our risk to go down, but our returns to go up. And so within private equity, what gave us that sort of formula was really the secondary focus. I think what venture capital is obviously something very, very attractive. You get in early, the returns are pretty could be pretty enormous, and so but also the risks. So a long answer to the question, yes and no, I guess, is the answer. But it's something that we would look at, once we get comfortable, once we get more educated, once we have more experience in the private equity space. As far as the question, in terms of technology, I mean, I think technology, as we have seen, solves a lot, and so. But more fundamentally, I think in the region, especially in the Central American region, if we're thinking about onshoring and bringing back manufacturing, I think there's a lot of investments that governments, but again, these international finance organizations need to invest is in the infrastructure that goes around that technology depends on. Okay, high speed. Internet and these kinds of and other basic things, water, people being able to access water. I mean, these are very basic investments. So and on top of that, and maybe throughout sits the actual technology that could be that could propel these opportunities. So and hope I answered that question.
Thanks, Abdil. We got a question from Eric Osiakwan. Eric.
Yes, thank you. My question is to the LPs, and it's around whether your investing in asset allocation strategy has changed as a result of COVID. Are you still investing? If not, what has changed, and what should GPs pay attention to if they're still talking to you, they want to talk to you? Thank you.
I mean, I can take a stab at that, and if you want. Indranil.
Yeah, go ahead.
It's a good question, because I think I think and I hear a lot of pitches all the time. I think one of the sort of one of the turnoffs, I mean, I'm just going to put it that way, is when I sit with a potential GP or someone that's that's, has created a fund, and then they don't understand how we invest. And back to what I just said about how that particular fund that they are working with or creating fits into the particular portfolio that we have. Because it's not the same to talk to us where we have generally a public focused fund as speaking to an Alaska permanent fund who's 20 times our size and have a $3 or $5 billion focus on private equity. So it's really we know the opportunity. That's why you're trying to create this idea and create this fund and make the right investments. And so we sort of understand the growth potential, but tell us about the risk potential, how that would fit into our portfolio. So
we have another question now from Miriam Rivera. Miriam, you want to ask your question, and if you want to address it to a particular panelist, please let them know.
Actually, it was more of a comment. So I'll just make a comment. One, about venture capital as a part of a portfolio. We definitely look at that risk reward, and I think we could walk you through the understanding of how early stage venture can be a part of a diversified portfolio, and in fact should be. So I'm happy to do that as Ulu Ventures. But the other comment is really more about some of the discussion that we're having here around approaches within our different ways of trying to create more economic justice and also try to address the wealth gap. And I think that, as I've been watching the landscape over the last 12 years, my sense is that, we have people that are working in different ways to do that. And one of them is, very much focused on diversity first. And I think another group of us is focused on returns first with diversity. And I think both of those are an important part of our strategy as a community. One, I think that our approach of financial returns first and diversity as a part of that. And I think an important part, like we're top 10 in the nation in terms of percent of our portfolio in underrepresented minority founders. We're top 10% in the nation in terms of follow-on in our underrepresented minority founders. We think that that's important because we need to break the glass ceiling. We need really a lot of wealth in our communities. And when we see our underrepresented minority founders achieving that wealth, they reinvest in their communities of color. And so that's just a no-brainer. And then I think that we just need so much more opportunity for so many people, because we did our own analysis of what's happened in venture capital in the last 5 years. And each of the last 5 years, there's been under 100 venture capital investments made in underrepresented minority founders in the United States of America. That's it, less than 100. It's more like 80 something at the high. And so obviously that approach is not working, and we need to have just more investment, period, so we can identify a broader range of talent, because large pools and diversification do tend to be very important at the early stage in being able to identify talent. So I just want to say it's not an either or, I think it's an and.
When it comes to sort of identifying that talent and nurturing that, whether it be American talent or talent that's part of a Latin American or African diaspora that maybe wants to go back and do something, maybe if you have any comments, Stella or Ross, in terms of how you would like to invest to sort of develop that talent for benefit in the US, but also back in your continents. Any thoughts on what you're doing to help with that, and any connections you could make here to make that more fruitful?
Yeah, I mean, from my side, I think I would offer two aspects to other, if there's other LPs investing primarily in people of color in the US or developed market context. I'd love to, if there's opportunities to collaborate on deals in Africa or funds in Africa, that's definitely something that I think we at CDC would be keen to work on.
Terrific. Rodney Appiah has a question. Rodney, do you want to ask your question or make a comment?
Yeah, sure. And first of all, I just want to say thanks to Andrea and to Eric Collins for inviting me to this forum. Really interesting conversation. My question is really for Ross and for Stella, and it sort of builds on that point that Miriam was making around that difference between diversity first versus returns first. And at Cornerstone, we're very much a returns first organization with diversity. And the question I had for you both was really thinking about your strategies as it relates to investing in the diaspora from where they operate, as opposed to sort of investing in strategies that support them going back to their country of origin. And so the reason why I raised that as a question for you both is to what extent do you see CDC and the Nigerian Sovereign Wealth Fund having appetite to support funds that are seeking to back founders who are of Black or diverse descent, who are operating in their current countries as opposed to their countries of origin? That's my question.
So our mandate within the Future Generations Fund, which is the fund through which we would invest in private equity, venture capital, and the like, but it's actually global kind of mandate. So, we invest wherever we find GPs that we believe meet our criteria. So from that perspective, if you're BIPOC who's in the US or wherever you are, and you have a fund that is compelling and meets requirements, interests us, then we would look at your fund same as we would look at any other. It's only through the Future Generations Fund that we can do that. Our infrastructure fund is mandated to invest primarily in Nigeria. So, we're not able to invest outside of Nigeria if it's infrastructure related. So in that case, if you had a brilliant idea, you would have to come and do it in Nigeria, and then we would talk to you.
Great, thanks, Stella. Very clear.
And sorry, go ahead.
So can I ask just a follow-up question very quickly?
Go ahead. Yeah,
so slightly different question. Maybe Ross will kind of comment on this. Is one of the things that I've noticed sort of when speaking to LPs and speaking to other sort of investors in the ecosystem, particularly in this space, focusing on diverse and emerging entrepreneurs, is this obsession with finding the next unicorn opportunity. And I appreciate that unicorns are fantastic in terms of being a standard bearer of success, but unicorns are by their very nature very difficult to find. And so if we're serious about creating a sustainable ecosystem where we back entrepreneurs that generate capital, which hopefully then reinvest back into the ecosystem, shouldn't we think more carefully about the types of strategies that we're backing, i.e. scale up capital focused strategies, growth equity focused strategies, a focus away from technology towards more broader sectors, other industries where we want to encourage entrepreneurship from the diverse backgrounds. I think this sort of tendency to focus on unicorns and focus on technology is a little bit narrow, and I just wanted to get some thoughts from Stella and from Ross as to whether you agree with that thesis or not.
Everybody loves a unicorn. And I don't know that we will ever stop aspiring to find them, but it doesn't drive our investment strategy. We're not looking for unicorns specifically, and we wouldn't only channel investments to groups of folks that we believe will generate the next unicorn. But technology is here to stay. The world is gone digital. The digital economy is here, and I don't think we can get away from it. And so I don't think you would see a focus away from that. I think we should all embrace it and kind of work with it. That's my take on that.
Can I add to that, Engineer?
Please go ahead, Darren.
Just real quickly, because that certainly is a bit of our focus as well in terms of not, frankly, looking at unicorns, recognizing that there are a lot of very solid business opportunities, whether it be companies that can become, 10, 15, 20, $30 million businesses or better, and perhaps they're not sexy enough or disruptive enough for an institutional VC, but there are a tremendous amount of good businesses out there. And a lot of, tech entrepreneurs, frankly, fall through the cracks because their idea, frankly, was not deemed disruptive enough. That does not mean they cannot be relevant to a private investor. And so there's a lot of meat, if you will, and teeth to what was just mentioned about this obsession with unicorns, because we are missing a lot of good businesses out there.
Yeah,
Thank you, Darren.
we would agree with that, and it's really encouraging to hear that, Darren, that you share that view. And I think, particularly in an emerging ecosystem like the ecosystem that we all trying to serve, what we lack is success stories. And actually, we need more success stories. And if we have all of the capital chasing unicorns, we limit the number of good, positive stories that we can tell. And the more stories that we can tell, the more capital can flow into this ecosystem and the more mature it becomes. And so we subscribe to focusing on scale of capital, on growth equity. Let's create those success stories. Let's mature the ecosystem, and then let's go for the unicorn.
Great point, and great point to end with. Thank you for everyone in the audience for those amazing questions, and thank you especially to our panelists. This was really a fantastic discussion. Let me hand over to Denmark, who I think is going to make a few closing remarks, and then I think there's the GPLP session after this.
Thanks a lot, Indranil. First and foremost, I want to thank you, Indranil, for helping to pull this together and being such a strong host. I want to thank the speakers. This was a fantastic panel, and I received several comments in the chat privately expressing how impressed they were with the collection of individuals and the comments that have been made so far. Definitely want to thank the sponsors. Without the sponsors, these things are a lot harder to come by. And so whether it's the team from Google or the team from Samsung, we've got a number of sponsors that I want to thank. But I want to thank you all. Mostly I want to thank you all who are in attendance because without all of you here making this such a lively community, this is a different event. So thank all of you. One of the things that I think that's been particularly interesting for me is that there's both a conversation that seems to have a thread throughout of focusing on inclusive and equitable economies, as well as the growth and scale of individual firms. And I think the sort of combination of macro and micro perspective that is sort of woven through these speakers is actually one that's important for us as we think about building the communities, because it's also a way to tie the growth of the individual to the growth of the community, as long as we're thinking in a community mindset. And so as we sort of come back to the point of having a community mindset, having a growth mindset, an abundance mindset, and a generosity mindset, that all of these things actually come together, because we can quickly get to a point where if one of us wins, all of us will win, because we're all going to work together. With that, feel free to reach out and check out cultureshiftlabs.com for more information.